Hello, this is Paul Gibson once again with the Academy of Trading and Investing. We're going to continue our education today in investing in stocks. We're going to talk about dividend investing. This is a great way to create continuous income from your stock holdings or add it as a combination to your trading. So let's get going. We're going to cover a lot of definitions today, so I would suggest you take notes. We'll use these definitions later to help you create a model that you can use to help you identify if a company is going to be a good dividend investment process. So, a dividend is defined as a payment made by a corporation to its shareholders. Usually these payments are made in cash. That's called a cash dividend. But sometimes the company will elect to also have additional stock distributions or stock dividends, whereby additional shares of stock are distributed to the shareholders or given to the shareholders. These stock dividends are also sometimes called stock splits. Now, there are several different kinds of stock splits, and this is one type that can be issued by the company. Some companies also have DRIP programs. That means Dividend Reinvestment Program, where the dividend would be chosen by you to be reinvested in more shares of the company that would come to you. That is an elective to you, and it's not available with all dividend-paying companies. But it is available with some, so you'll want to check with your broker or with the company to make sure that it is invested properly according to a DRIP, if that's your selection. How often is a dividend paid? Well, a dividend is declared by the board of directors, usually after the earnings announcements. The payment frequency is declared by the board and could be annual, semi-annual, or quarterly, which is the most common. It could also be on a weekly or monthly basis, but that would be highly unusual. It's also possible that a special dividend could be declared, which is unscheduled. That way the board of directors is probably trying to attract more investors or reward their current investors for some reason. Perhaps they have made a special earnings or a special project has been completed. The dividend declared is in dollars per share, but could be zero. So as the board of directors meets, they issue shares to common shareholders, but that dividend could be zero. The frequency is not required in any particular schedule, but boards tend to follow tradition and try to meet the expectations of the shareholders, if possible. They do like to keep the shareholders happy. So what's the difference between dividend rate and dividend yield? Dividend rate is the dollar amount of money distributed to the shareholder for each share of stock the shareholder owns. It is presented as an annual amount. For example, if the dividend rate is $4 and the shareholder owns 1,000 shares, then the shareholder would receive $4 times 1,000 or $4,000 each year in dividends. The rate is expressed in annual distributions. If the dividend paid is quarterly, then the shareholder would receive $1 per share every 3 months. In this case, $1,000 would be paid in each 3-month period if the rate does not change. The price of the stock does not influence the amount of money paid to the shareholder. However, dividend yield is a little bit different. It is calculated by annual dividend paid divided by the current price of the stock, not the historical price or the projected price, but what is that stock trading for today. Example, if the annual dividend rate is $4 as discussed, and the price of the stock today is $100 per share, then the annual yield would be calculated as $4 divided by $100 or 0.04, which as you know equals 4% per year. If the price of the shares goes down to $80, the yield would then be calculated by $4 divided by $80 or 0.05, which is 5%. If the price of the shares rises to $120, then the yield would be 0.0333 or 3.33%. if the dividend stays at $4. Many times the company will adjust the dividend to reflect the traditional yield of the dividend. So if the price of the stock drops to $80, The board of directors may declare the dividend per share to be now only 80 cents per share instead of the previous $1 per share. We don't know what that dividend is going to be until it is declared. So we have a declaration date, we also have an award date, and we also have a payment date. So those are the three dates that come with a dividend. The board of directors declares the amount to be paid. Then we have the distribution date, which is when the shares are actually paid on or the dividend actually arrives to the investor. What is the money source of the dividend? Well, it comes from corporate earnings. In other words, revenues earned. And that comes after the calculation for operating expenses, salaries, and other general and administrative expenses. For the accountant, the dividends are deducted from the EBITDA, the earnings before interest, taxes, distributions, and allowances. Dividends are considered as a distribution expense to the company. For this reason, dividends paid may fluctuate or change over time as the revenues of the company change, and the board of directors decides what it's going to be this quarter. So here's an example for General Electric Company. Here is a list of the dividend dates, amounts as found on the NASDAQ.com. So we have the effective date, 6/28/2019. Type of the dividend is cash. The amount paid in cash is 1 cent per share. Declaration date is 6/21. Recorded date 7/1. Payment date 7/25. And we have a history going back, clear back when they were paying a great dividend of 23 cents a share back in 2016. So we have a history of how that's been paid in the past. Here's a reflection from Morningstar.com of their presentation of dividends. As we can see here, we have a total yield presented historically. So back in 2018, the yield was 4.89%, and the dividend per share was 37 cents a share. We can see that this dividend has been going down over time. That would be a concern to us. By the same token, the yield has been going up, so that would be a good thing to know as well. This dynamic means that the stock price has been coming down. So less paid in actual dividends, but the yield is going up, which means the price is coming down. So the current trailing dividend yield would be $1.44 per year. Now here's what's known as the payout ratio. The payout ratio is a calculation of how much of earnings from the company is going to be paid out in dividends. It is the percentage of earnings paid to the shareholders. The amount that is not paid to shareholders is retained by the company to pay off debt or to reinvest in other core operations. It is simply referred to as the payout ratio. The dividend payout ratio provides an indication of how much money a company is returning to the shareholders versus how much it is keeping for itself, or to pay off debt, or to add to cash reserves. As with all ratios with dividend evaluation, we are looking for long-term stability to enhance our forecasting confidence. Return of equity is another ratio that we will look at as we start doing our calculations. Return on equity is a measure of financial performance calculated by dividing net income by shareholders' equity. Now don't worry about that. These ratios are always calculated for you and they're easily found. Because of shareholders' equity is equal to a company's assets minus its debt, ROE could be thought of as the return on net assets. ROE is considered a measure of how effectively management is using a company's assets to create profits. As always, we seek to find long-term consistent figures for ROE and hopefully a little bit of growth. This ratio should be compared to the industry average and should not be at the high or the low end of that range, but hopefully a little bit above that range, a little bit above average. So we want to always compare a company's ratio with the industry average. That's how we know if it's good or bad. Just looking at a number doesn't tell us if it's good or bad. The comparison is so vitally important. We also want to look for a sustainable growth rate. This is a ratio published figure, and it comes from the company management. It's a projection of how much the stock price is going to grow over the next year. As with all ratios, once again, for dividend evaluation, we are looking for long-term stability to enhance our forecasting confidence. Has the company forecast prediction been reliable over the past period of time, either 5 years or 10 years or whatever we're looking at? We want to match their forecasting ability with their reality. Another interesting figure is cost of growth. Once again, you won't have to calculate this. I'll give you a tool that will calculate it for you. So core growth divided by return on equity times earnings per share equals the cost of the growth. This ratio helps us to see how much will be needed to be spent to grow the company over the next little period. Lower ratios are more reliable. Higher ratios leave us suspicious that the company can actually grow at that stated forecast rate. And sometimes companies do overpredict. A reasonable minimum expectation would be the rate of inflation. Any projection beyond 10%, however, needs a reasonable explanation as to why that is possible. As with all ratios for dividend evaluation, we are looking for long-term stability to enhance our forecasting confidence. Has the company performance been reliable over the long term? Once again, 5 to 10 years. Funding gap. This is calculated by earnings per share minus dividend rate minus cost of growth equals the funding gap. We will be calculating that using the spreadsheet that I'll give you so that you know what that funding gap is. This is where we subtract the funding gap from earnings per share and see how much money is left over for the company to fund growth and perhaps buy back its own stocks, which gives us additional value in the company, by the way. Too many shares out there can actually dilute our ability to earn income on that stock. So the fewer shares there are, divided into the amount of money available for dividends, gives us more dividend per share. As always, we look for the historical consistency in a company's ability to pay dividends and to look at that ratio. So we also want to know how much that share price is going to change during the year. This is purely theoretical, as nobody can really predict the future. It is assumed here that with the funding gap being available for growing the company, that the revenue growth and hence the share price growth will be at a mathematical certainty, which it is not, but that's the only tool that we have, so we use it. But it's the only method that we can use to help us guess what stock price may be in the future. So we're going to take an educated guess. Another method would merely be to look back over the history of the stock price over the past 5 to 10 years and see what kind of average increase or decrease the stock has over that period of time as a percentage. This supposition may be false, as nobody can predict the future, but once again, it's the only tool we have, so it's the tool that we use with a conservative rule of thumb. So how do we put it all together? I've created a spreadsheet for you. If you know what the dividend rate is, we can input that. That's available, it's published. We know what the current share price is. The spreadsheet automatically calculates our current yield. Then we can put in the core growth rate, which is a prediction by the company. That's also published. We can also pick up the ratio return on equity. That's published. We can then pick up multiplied by earnings per share. Once again, that's a published number, and that gives us our cost of growth. All these blue cells are automatically calculated for us, so we only have to come up with 5 sets of data which are published with the company financial records. Or just go to your broker. They can tell you what those numbers are. So then it calculates earnings per share, minus the dividend, minus cost of growth. Funding gap is $1.20. Once again, our funding gap is calculated for us. Price per share gives us our share change in price, expectation for the future. Core growth rate plus share price change. Total dividend growth expected would be 7% in this case. Plus the dividend yield is 2.1%. And our projected total return, the growth of the stock price, and the dividend rate gives us a total expectation of dividend plus price growth to be 9.4% in this case. We're using the historical records from the Hershey Company from 2007 just as an example. So once again, this mathematical model gives us some ideas of how we can compare figures from company to company, logically looking for the best result. The assumption is that all compared companies being compared have reliable long-term performance numbers. So we'll take a look at the history year on year to make sure there are a few variations in the data that we're collecting. We'd like to see steadiness over the long term. That makes our forecasting much more reliable. So we're looking for the projected total return for that company. So this detail might give you a little bit closer look. Once again, current dividend rate, current share prices, we calculate the yield, then we input the core growth rate, return on equity, multiplied by the earnings per share. The spreadsheet does all the calculations for you. That spreadsheet is available on www.academyoftradinginvesting, at www.academyoftI.org, and you can find that spreadsheet there. It will be under the Tools section. What's the weakness of this method? Well, it's important that we can find reliable data in determining if the long-term history is a fair expectation for the future. Keep in mind that future dividend growth is essential for the long-term success of the company, so they're going to be interested in that. Investors are more likely to stay with a company that has continuous growth. Beware of the fluctuations in revenue production and unsteady dividend payouts. That's a red flag, so we look for continuous, steady performance, hopefully steady increases as well. Research of the manager of the company to verify that not only could they pay the increasing dividends, but they have the ability and will to pay for it. So you can call their investor relations department and have a conversation about that if you like, or you could talk to your broker about that as well. So here's some additional things to consider. We want to be suspicious of yields less than 4%. Obviously, if a company can't keep up with inflation with their yields, then something's wrong. We should be able to get at least inflation out of our investment. So a 4% is a good rule of thumb. Inflation is usually somewhere around 3%, so we want to do better than that. And of course, anything greater than 7% is also suspicious. I've seen companies offering 20% dividends, and that sounds wonderful. But the truth is that company defaulted on its dividend payments, and eventually, within a very short period of time, about 2 years period of time, was actually forced to go bankrupt by the Securities and Exchange Commission and was kicked off the trading floor. So that stock was no longer traded. We want to look for a target of an aggregate total return that's around 9%. That's a good rule of thumb. That would be a good stable return. Now you might get a little more, you might get a little bit less. It really is going to be dependent on what your risk tolerance is. Another way to see what we might pay less for a stock is to wait for the stock price to go down arbitrarily low, and through technical analysis, which we've discussed in another video, we can figure out what a good price for that stock would be, buy it at a low price, and there increase our basis cost for that stock, and obviously also increase our yield for that stock because we got it at a good price. We also want to determine what your total return requirement is for you. How much of your funds are going to put into dividend stocks? Will this portion allow you to reach your investment goals? We also want to compare your stock picks to their respective industry, as I mentioned before, to make sure that you are getting the kind of investment that you want and staying in the mainstream. That'll help you gauge your risk and return. It's awfully tempting to take a wild guess at a new and up-and-coming company. They do pay well, and it can be a huge payoff, as we've seen with Google and Netflix. and Amazon and some of those historically volatile stocks that have done really well. But for every stock that does really well like that, there's probably 100 that don't do well, and probably 20% of those eventually are deleted from the stock market because they just don't trade well. So be very, very careful about taking huge risk. We also want to know what we own. We want to keep track of the company's changes and watch the news over time. Don't be afraid to sell at the appropriate time if needed to protect your capital. Cash in hand is always better than a bad investment. So staying in a cash position is also an investment strategy. We don't have to always be anxiously engaged and involved in trading or investing. Managing our money is probably a more important activity than looking for the next best investment. So once again, this is Paul Gibson with the Academy of Trading and Investing. It's been a pleasure to be with you today. As always, I would recommend that you pick up a copy of Notes from a Profitable Investor, as found on academyofti.org. We could also look to morningstar.com for more references. It's one of my favorite resources. Notes from a Profitable Investor is now also available on Amazon and on Amazon Kindle. Or check out our coaching services at academyofti.org. If you'd like, one of us can help you through the investing learning process. We'll go through these concepts with you and help you learn how to implement them and use them in actual online tools. We'll look forward to talking to you another time.